Hi everyone, let's talk about how you can sell ES futures LEAPS safe and simple with a win rate of over 97%. So it's pretty simple. It's not a lot of risk, so it's not something that will change your trading forever, obviously. But this is what I found to work and to still be safe and simple. So the short put should be a delta 1 to delta 10. And we will have to analyze the graph to decide exactly what delta it is, which we will do in just a second. The DTE is always around 365, so LEAPS are at least a year, and some people go 2 and 3 years out. I would go probably for just around 365 days, and no more most likely, just because with futures it's a bit different, and you also want to make sure that you have a liquidity. For the position management, the profit target should be 50% of credit. Now, some people can hold it for more, 60, 70%. It doesn't really matter, but the most optimal results will be at 50% of credit because you can quite quickly get there. Then we can reopen a new position. Now for the risk management, it's selling the future contract if the price reaches the short put strikes, which is really unlikely, or you can just roll the put at certain degree. Now, the most important thing is the position sizing. It has to be one contract per every $100,000 in an account. So if you have a $1,000 account, you will only use one contract. This is really important. This is where people usually fall, and they just over leverage and they open a few of them. Because if things go bad, and this is the main concern with these kind of leaps. Things go bad and the ES is just crashing down, then you definitely don't want to be over leveraged because margin requirements will go up substantially, and you might need to be forced out of the position because of it, even though your position is far out of the money. Right? This is usually how people end up losing when they do these kind of trades. Now, when do you do it? Is really very simply when price it must be in a clear side trend or uptrend. The S&P is mostly, or the ES is mostly uptrending. It doesn't really matter when you do it. Just if we are in a recession, then maybe you don't really want to do it. It might not be as effective. Now, I know it's pretty hard to look at the graph here, but this is the September 2026 expiration on the ES. So you can barely see the price here because there's not much liquidity on the future itself. The options are totally fine. So just analyzing the graph, this is what I would choose as a safe level to sell the put strike at 4,400. So it's just underneath this decline in October 2023, and we just have a massive buffer zone. So the price has to go about 34% down for us to really get to the point where we might need to either take assignment or sell the future contract or just roll the contract itself. Now again, it's really unlikely, and I always like to be way more safe than I need to be. It's proven to work for me. And again, the biggest thing is keeping the position size small. If you don't do that, then you are guaranteed to blow your account at some point in your trading career. If you keep your position small, if the most terrible thing happens, you will still be able to deal with it and be able to somehow even profit from it. So it's all about position sizing. This is what makes or breaks great traders, and I stand by it. Now this expiration is 321 days. It's kind of, I guess, the closest to 365. You can also go with 401. I will go 321 days. And we said the strike we are choosing is 4,400. So it'll be this strike over here. As you can see, we have some liquidity here. The market makers are definitely supplementing this expiration. So opening position is going to be really easy. You can see there's 300 orders on one side and 315 on the other side for the bid and ask. So there should be no issues at all. If we take a look at the profile here, so we can basically get about $2,200 in credit, and even on interactive, it says there's a 100% chance that you will keep the entire amount. Now, if you look at the theta currently, and let's say we're taking profits at half of this, so it means we're taking profits at about 1,100 with a theta of $15. You are looking at anywhere between 80 and 100 days to take the 50% profit. Then you can obviously reopen the position. The margin is $8,000. And again, this is what I would do for a $100,000 account. I wouldn't go 2 or 3 contracts, which is obviously very tempting. But again, remember that we need to think about risk and think about how we preserve the capital if the worst case happens. What is the action plan? And by keeping the position size small to begin with, like really any action plan will help or be able to deal with the situation. If the position size is too big, even if we do 3 contracts, it's game over. Really, there's no way that we'll be able to deal with the situation if the market crashes. So this is something important to mention. And this should be it for this video. I think it's pretty simple and safe. You'll have basically, according to Interactive, 100% chance of profiting on this specific position that I showed, which again, obviously it's very likely. It's not much, but slowly but surely, if you do those leaps on different products, they end up collecting quite a bit of profits, and you end up making a really nice return, basically stress-free, and with a really high probability of profit. Again, thank you so much for watching, and I will catch you in the next one.